Hi everybody, this is the investing teacher, high school science teacher, teaching others how to invest. In this video I want to go over ticket symbol SNDL and how I'm using a theta gang strategy to receive a lot of shares and collect premiums through covered calls and possibly cash secured puts, and how it could make a very good cash flow over time. Let's get right to it. Let's look at sundial growers. Let's take a symbol SNDL. Currently is trading at $1.04, but there's been a lot of volatility. In the last 5 days, it went up 85.71%. Notice that it was in the 80s for a lot of last week. Then it jumped up on Monday all the way up to $1.17 or so cents. And then yesterday on Tuesday, it dropped down a bit to $1.05. So here is the position that I used for sundial on 201, essentially, even though these are different transaction dates. I bought quite a bit of SNDL. I bought at 1.05, 1.01, 115, 119, and 94 cents, which is the best one so far. And then I sold some covered calls, 12 of them at 21 cents, and another one at 15 cents, and then bought to close at 10. So I made a net profit of 11 cents times 12, which is a pretty good trade there. And then I ended up buying more shares. And yesterday I actually bought another set of covered calls of 14 of them at an average of 25 cents. I did make the expiration into 2 weeks from now, so February 19th. So all in all, I have a pretty big position in it, even though the share price is pretty small. Currently at 1,400 shares, and I sold 14 covered calls. Let's look at the actual numbers. Okay, so here I showed the total positions that I bought. So I had 1,200 shares, 300 at 101, 394, 100 at 105, 200 at 114, 300 at 118. I did sell these on Monday with a buy right, meaning that I bought the shares and then I sold covered calls, 1.5 for all of these. Date of expiration was 205, so just a weekly expiration. Again, stock price was 1.01 on average, strike price 1.5. I received $243 in premium for 5 days. The benefit is if it goes up to 1.5, I would then sell all those shares at about a 50-cent per share gain. And I also get to keep my $243 in premium. I ended up buying to close this position at $120, literally yesterday morning on Tuesday, for about half of the profit. My profit and loss in a day was $123. And the reason why I did that was sundial did go down on Tuesday. So I was able to buy to close most of those at 5 cents. And then I sold more. Again, with 1,300 shares, I was able to fill at 219. Again, the 150 covered call price. I received $254 more dollars, and still waiting to see what's going to happen here. So my total premium was 243 plus 254, 243 plus 254, $497. I did buy to close at 120, so I have a net income from premiums of $377 already. Notice out of the 1,300 shares, that is a very high percentage compared to the upfront costs that I had. My total cost basis was $1,366 minus the $377 I have in premium. My total cost basis currently is $989 for this amount of shares. Now, currently the stock price is a little bit over 1.04, so I do have a slightly net gain already. If it gets to 1.5, then I'll be able to get over a $500 gain as well from this position. if I'd had to sell my shares at $1.50. So here's a strategy that I've been considering doing, and I want to look at the numbers to see if it works out. I posted this on the Theta Gang on Reddit, which they take Wall Street bet stocks, but they go the other way. They sell premiums and sell calls and puts. I'd like to hear your opinion on this. The stock is currently at 1.04. You could sell one cash secured put expiring 2/19. So that means that it would have to buy at $1 if it gets lower than $1. The bid is 0.25 and the ask is 0.3. So let's say we get at 0.25, you would be making $25 per position while only holding $100 in cash secured puts that gets to leave in your brokerage. That's a 25% return on your money if it expires above 1 in 2.5 weeks. Also, the volume is very high. We're getting tens of thousands of option positions on this. Now, let's say that the stock goes under $1. Let's look at the covered calls. Right now, the covered call for 1.5 has the exact same bid and ask. 0.23 is the bid, 0.3 is the ask. So if you get assigned, you could wheel it for the same amount, meaning you sold the one cash secured put. Let's say the stock goes below 1. You would then own 100 shares. At that point, you could sell the covered call at $1.50 and then get a very similar bid-ask price. So I'm running for 1,400 shares. My average cost is 0.94. Currently have 14 covered calls at $1.50, expiring 2/19, and I did receive the 0.25 premium. If it doesn't go past the 1.5 on 2/19, you can sell 14 more covered calls, use those premiums to buy more shares, rinse, repeat. So if I could get 0.25 premium, $25 premium, times 14 covered calls, $350, say the share price is about $1, 350 shares, you could get at least 3 more covered calls, 3.5 almost. All I have to do is buy about $50 more, and you could actually sell 4 more covered calls at this 0.25 possibly. Okay. Is this a decent play, assuming the stock doesn't go bankrupt? Here's what Reddit thinks. When playing SNDL with good results, the premium is just too high to pass up. But most of these selling in the money covered calls, that means they're selling at 1 instead of 150, and he's letting about 8% every week or two. Or a good point. I'm not buying into money since it's so close, but I do see the point when it was 0.75. Right now, when he was doing it, it was 0.75. He was selling covered calls at 1. I'm in a similar situation. It's 1.04. I'm selling covered calls at 1.5. And he wrote, yes, I was buying at 60 and selling the covered calls. Okay. Another person bullish. It's a money maker in the short term. No debt. Poised for payout. Should meet the listing requirements by June. That is something we will mention as one of the possible negatives. And he has $1,800, 1,000 shares at 0.85. Covered strangles is another way to go, where you could sell puts and calls at the same time. And there is more examples. Covered strangle SNDL on Reddit. And then that's pretty much it on that. I wanted to go over what I actually did, and this is what I posted on the Option Wheel Facebook group. I did manage my SNDL well. I bought to close 12 covered calls at 0.05. Then I sold to open 12 covered calls at 1.5 and for 219 at 0.25. I mean, it's $25 per covered call. A little luck because it got filled because it could have been 0.2. At the time, the bid was 0.2 and the ask was 0.25. I put an order in to sell a covered call at 0.25 and I luckily got it. If I got it at 0.2, that would have been $5 times 12. That would have been a $60 difference, which makes it pretty dramatic numbers in the profits. Here are some risks. There are a lot of people that trade it. Will they be delisted? NASDAQ recently gave the company extension till June 26th to get the share price over $1. That's a fairly good amount of time to reach a low benchmark, but there are no guaranteed that it will stay in NASDAQ. If it doesn't go in the NASDAQ, that could significantly hurt the share price. So that is a big risk to consider. Okay, I'm recording this at open on Wednesday, 8:38, and the stock is skyrocketing 20%. That changes some of the numbers around a little bit. You could sell a covered call at 5.19, so 17 days from now, receive 35 cents per covered call. That'll be $35 for each position that you make. The calls that are even before this, if you want to look at February 12th, you could still receive 25 cents per covered call. It's $25 per covered call. So here's a possible action plan that you could do. You might have to get on this pretty soon because obviously the prices will change very quickly. You could buy 100 shares of SNDL right now. It'll be even more than this now because the stock price went up. It'll be about $12.40. Then sell 10 covered calls for 1.5, expiring in 3 days. And you can make $25 per covered call. $25 times 10 is $250 net gain. And you have some upside because if it goes to 1.5, you'd make another about $200 in 3 days. So there is a lot of return possibilities on this stock. Let's get on it soon, guys. All right, so again, I'm the investing teacher, high school science teacher, teaching others how to invest. Hopefully this information might be helpful to you if you're currently trading. Again, look at SNDL. It might be a very good position. There is quite a bit of risk in the actual stock, but it's a little less risky when you look at the covered call premiums. Thank you for watching until the end of the video. Like, subscribe, share, all that good stuff. And any questions, feel free to let me know. I read and respond to all comments. And I'll talk to you guys next time.